Hello and welcome to part 2 of the lecture for chapter 6. In this part, I'm going to talk about bank reconciliations and petty cash and a little bit about the role that auditors play in the accounting process. So first of all, why perform bank reconciliations? Another word for that is why reconcile our checking accounts. Well, to start at that, let's talk about what the word reconcile means. So the word reconcile means is taking information from two different sources and looking at the differences between that information and making sure that you're comfortable with all of those differences so that you believe both sets of information. In the case of cash, the two sets of information we have are what the bank says we have in our bank account. That's evidenced by a bank statement. So those of you that have checking accounts will probably get an email with a bank statement, or you can go on the bank's website and look at your bank statement as in a PDF form. In the old days, they used to mail it to you. So here's an example of a bank statement. So it shows the account number. And again, keep in mind that companies, as opposed to individuals, might have multiple different checking accounts. They might have checking accounts for different locations. They might have checking accounts for payroll versus bill paying, all of that. So they'll have different account numbers for each of those bank accounts. In this case, it's for what period of time? It's from July, or rather the end of June through the end of July. So it's for the month of July. And up in the upper right corner there, it gives us a recap. What did we start with? What was added to our account? What was subtracted from our account? And what's our ending balance? And then it gives us the detail for that. And it would often include a scan of all of the checks that cleared our checking account as well. So not only, for example, could we see on this statement that check number 850 was for 8/19/40, I could also go look at a copy of that check, often in the same PDF. It'll also show deposits that we've made, and the date and the amount, and it'll show different kinds of charges that were made. ACH is automated clearinghouse, a type of wire transfer or electronic payment. And then there's miscellaneous charges and that sort of thing. So the reason that we want to do a bank reconciliation for every account, for every month in every company, is that we might find out information that is not included in our accounting records. So as an example, if our bank assessed us a charge for, say, printing new checks, they would just charge our checking account. They wouldn't send us a bill. We wouldn't write them a check for it. So that expense and that decrease in our cash account, we wouldn't know about it if we didn't go through the process of reconciling our bank statement. So one is we're going to find expenses or potentially deposits, money the bank put in our account that we wouldn't have known otherwise. So we're going to find those things out and then be able to include it in our accounting records. The second is we might find mistakes. Humans are involved in this. Banks make mistakes. Companies make mistakes. So this is one way of finding those mistakes. Maybe I wrote a check for $950 and I recorded it as $590. So I'm going to find those kinds of mistakes. And then lastly, I might find fraud. I might have signed a check that was for $100, and I might see when I look on my bank reconciliation that the bank cleared that check for $1,000. Somebody added a zero to it and altered the check that I had written and signed, and I wouldn't know about that again if I didn't reconcile my bank statement. So here's an example of a company where, and this follows the bank statement that I just showed you, where according to the bank statement, the bank says that we have $3,359.78 in our bank account. That's obviously an important piece of information for our balance sheet. How much cash did we have? When I look at my accounting records, I can see in my financial statements that I've got a beginning balance of $42,2760. I've made deposits. I've written checks. I have an ending balance of $25,49.99. Why is there a difference between those two numbers? That's the purpose of this reconciliation, is to figure that out. Okay, the real amount that we have in the bank, or the real amount of cash that we own, is probably a number between those two numbers. It's neither of those two. So when we do a bank reconciliation, we're going to do it in two parts. We're first going to take what does the bank say that we have in our account, and let's make adjustments to that for all of the things that we know about that the bank does not know about. So as an example, if I made a deposit after hours on the last day of the month, I'm going to record that, in this case in the month of July, I'm going to record that in my July accounting records. That's not going to be reflected on my bank statement for July because I put that money in the night deposit box after the bank closed. So it's not included in what the bank reports to me. So that's often called deposits in transit. So it's a deposit that's kind of on its way to my bank account, but not all the way there. So I'm going to add that back to what the bank says I have because it's not included in their balance. There's also outstanding checks. So if I write a check to somebody in New York and I write it on the 30th of July and I put it in the mail, I'm going to deduct that in my check register, right? I'm going to deduct that in my accounting records. But the bank hasn't seen that check yet. It's got to make its way to New York. That person has to deposit in their bank, and that bank has to present it for collection to my bank. That's when my bank finds out about it and takes it out of my account. So if that hasn't happened yet, those outstanding checks are still out there. The bank doesn't know about them, but really the money is no longer mine. So I'm going to deduct those outstanding checks, the amount of them, from what the bank says I have. And then lastly, I'm going to determine, are there any errors the bank's made? Because if the bank has made a mistake, then I either need to add money back to what the bank says I have or take money away from what the bank says I have if the bank made a mistake. Now that's pretty rare, but it does happen. So and I would take a look at exercise 6-11B, and I'll post a separate video for going over that. The other side of the reconciliation is looking at the company side. So here I'm going to start with what does the company say that they have in their checking account. Okay, that's based on their accounting records. And I'm going to make adjustments for all of the things the bank knows about that I don't know about. So the bank knows about deposits that they made without telling me. Like if a customer mailed a payment directly to my bank for deposit into my account, that can happen sometimes. So I may not have recorded that yet. So that I need to know about. There might be deductions that the bank has made, like I mentioned, a charge for printing checks, service charges that the bank assesses, NSF checks. So that's a check where somebody has written me a check to pay me. I increased cash, I've reduced accounts receivable, but that person didn't have money in their bank account. So it looks like I've recorded a deposit, but the bank's going to charge it back against my account. So I need to make an adjustment for that. I need to reduce what my cash balance is for that amount. And then I might have made errors. I might have written down a check incorrectly, recorded it incorrectly, and I'll find that out as part of this process. I need to adjust for that. All of the company adjustments, I'm going to need to record those in my transaction grid once I find them and determine them. Okay, once I'm finished with this process, I'm going to have some transactions potentially that I need to enter in my accounting records so that my accounting records are up to date. I don't have to do that with the reconciling items for the bank balance because those are already in my books. I just need to do it for the company items. So I would look at exercise 6-12B for this part of the reconciliation. So the overall reconciliation, the top part is the bank portion. So I start with the balance according to the bank. I add back the deposit in transit. I subtract the outstanding checks. That leaves me with an adjusted balance of $2630.99. Then I have the company section. The company started out with $2549.99. There was an amount that was collected by the bank that we didn't know about, so I'll plug in that 408. There were some charges the bank made to our account that we didn't know about. There was the NSF check, or the insufficient funds check, of $300. I have to take that away. I have to reduce it for a bank service charge, and then I found an error that I made for $9. So I'll reduce it by those amounts, and I get an adjusted balance of $2630.99. So in this case, I am reconciled. Okay, so that's how we do a bank reconciliation. I've posted an example of one from a company that I used to work at that contains a lot of these same issues. and I'll post both the worksheet to be able to do that. So the cash register, the bank statement, and the bank reconciliation form on Moodle, and then I'll post the solution. So I would suggest kind of printing that out and taking a look at that and walking through those steps. Okay, the next topic I want to talk about is petty cash. And petty cash is currency that a company keeps on hand, usually in a locked box that somebody has control over, and it's used for things like they want to buy pizza for the staff on a Friday, so they take some petty cash and pay the pizza delivery guy, or they need stamps, or they need to put gas in the company car, or something like that. They'll use small amounts of cash for that. It's funded to a set amount, and it's a separate cash account. So think of our transaction grid. We would have a column for cash, that's our checking account. We would have a column for petty cash, that's currency in a box. So when I fund it to begin with, I'm going to be reducing my cash, reducing my checking account, and putting money in a box, so increasing my petty cash account. So the way companies keep track of that is you could record an expense and record a reduction of petty cash each time you took money out of that box for every little amount, but that's not really very efficient. So the way companies usually do it is they take money out of the box, they put receipts in the box for all the money that comes out, and at the end of the month they count the cash in the box and they bring it back up to the set level that they've agreed upon. Like maybe they say, we want to keep $100 on cash at all times, or whatever the amount is. So if we've gone through the month and taken money out and put receipts in, then we're going to fund it back up to that $100 level, and we'll recognize expenses relative to all the receipts that were put in there. So here's an example in the transaction grid. So the first transaction there, we establish the petty cash fund. Take cash out of our checking account, put it into that locked metal box. Okay. Now during the month, we disperse petty cash funds. People, I want to buy pizza for the staff, we give them 20 bucks, all of that happens. And we don't record anything at that point. So there's no transaction recorded for step 2 there. Then on step 3, I'm going to go through the receipts and recognize those expenses. So I'll reduce petty cash, reduce retained earnings to recognize the expense, and then I'll fund it back up to that set amount. So I'll take $216 out of my checking account and put it into that metal box. Now my balance is back up to $300 at the end of the month. So again, look at 6-14 for this for some help with this one. Lastly, I want to talk about annual reports and audits. So an annual report, a company will produce its year-end financial statement, and again, that's being produced for the stakeholders. It's being produced for the owners of the company, for creditors of the company, for potential investors, and for government entities that need to know how the company did. So it's going to include the financial statement. So it's going to include the income statement, statement of stockholders' equity, the balance sheet, and the statement of cash flows. So it'll have all of those statements. Usually not at a great level of detail, but fairly high level. Then there'll be notes to those financial statements, and that's where all of the details will be included. So I might say that I've got inventory, but then in the notes to the financial statements, I might give details about what kinds of inventory I had, maybe by product line or by what stage of production it's at or something like that. So the details that support the financial statements will often be in the notes. In the notes, I'll also describe what my accounting policies are. So do I use FIFO, LIFO, or weighted average? Those kinds of things I'll disclose in the notes to my financial statements. Then there'll be a large section called Management's Discussion and Analysis, and this is especially large for publicly traded companies that buy and sell their shares on stock exchanges. So that discussion and analysis is where the company kind of sells how they're doing in a way. If they've had problems, they'll disclose them there and say what they're doing about them. If they've got good things right around the corner, new products about to launch, those kinds of things, they'll disclose that. But basically, this is where management says this is what we're doing, okay? And they analyze the financial statements. If they might talk about future cash flow trends, those kinds of things. And then all of that will be audited by an independent auditor. So an accounting firm. So the company will go to an outside accounting firm that's objective and independent, and they'll ask them to analyze the company's financial statements and the notes to the financial statements. And the auditors will do a variety of things. They'll do some analysis, like how have things changed over time, and look for things that are outliers. They'll also do testing. So if the company says these 100 people owe us $100,000 in total, well, the auditors are going to contact a sampling of those people independently and say, please tell us how much company XYZ, how much you owe to them. And they'll compare that to the company's records. If the company says we have $100,000 of products on the shelf, the auditors will show up and observe the counting of that inventory and do some test counts and see, is it indeed accurate? So they'll do that for all of the things that management asserts. And management's going to assert that the cash we have is really in the bank, that the amount people say that they owe us is truly there and it's complete. It's not missing anything and it's not overstated. All of the items on the financial statement are claims management's making about what happened in that company and what the condition of the company is. So the auditor is going to do that work, and they're going to either issue an unqualified opinion, meaning we've looked at everything and everything management says is accurate and it's in compliance with generally accepted accounting principles. That's the goal of any audit, is to reach that point where the auditor provides their blessing to the financial statements of the company. They could issue a qualified report, so it could be we agreed with everything except for the inventory, which we weren't able to observe. So there might be kind of a everything's good except for kind of an opinion, or there could be an adverse opinion, which is we don't believe these financial statements accurately reflect the condition of the company, period. So all of that is intended to lend credibility to the claims that management's making about the financial condition of the company. So as an investor, that would give you an unqualified opinion would give you greater assurance that the financial statements are correct and can be believed and you can act upon them. Or you're a creditor and you're willing to make the company a loan. So would I loan money to a company that didn't have any kind of outside review of their financial statements? Absolutely not. So that's the purpose of that. So if you have any questions, please shoot me an email, and I look forward to talking to you when we start Chapter 7. Thank you.